To help us break down his expectations for the sector in 2025, let's bring in Gerard Cassidy. He's the co-head of Global Financials Research at RBC Capital Markets. Gerard, thank you for being here. Let's just start kind of broad. What is your outlook for 2025 with regard to the banking system? And did last week's Fed decision and Fed press conference change the game at all?
I don't think so. And thank you, Leslie, for having me on the program. What I would suggest is that higher for longer is an expression that you'll hear bank investors use. And what that means is that if the Fed lowers the Fed funds rate, let's say to 4%, which is higher than what many people thought as recently as 6 months ago, and the long end of the curve comes in at 4.5%, 4.75%, that's a positively sloped curve. So the banks get the benefit in two areas. One, the front end of the curve remains higher, which means all the loans, commercial loans in particular, that are priced off the short end of the curve remain at higher yields, but at the same time, they have a positive slope. So that means putting out loans in the 5 or 7 year time frame, they also get a higher yield. So what the Fed came out with last week talked about economic growth has been good, and we expect that to continue in 2025. And if the rate environment stays around, again, 4% Fed funds, 4.5 long end of the curve, that's also very positive for the banks.
So I agree with you, and that's why I was so surprised to see the sharp sell-off that transpired on Wednesday after that press conference. Why do you think the market reacted so strongly, especially as it pertained to those banks that are a bit more capital market sensitive?
It was interesting. I agree with you. What the Fed said was not necessarily negative for the banks, but there's an old axiom that many investors use that banks borrow short and lend long, so that when the yield curve steepens even further, that's even better. And that may have been some of that kind of money that had come recently into the banks because of the expectation of more Fed fund rate cuts. But also, I think some of the trade-off could have come from, the fear that this inflation trade may not be working as well as everybody would have liked. And that's a key risk for bank stock investing in 2025, is that if inflation reemerges and the Fed has to pivot and reverse itself, that would not be very good for bank stocks. And we're not expecting that, but that is a risk that we all have to keep an eye on.
Gerard, I mean, the case for a lighter regulatory touch is obviously a very persuasive one going into the next Trump administration, whether it means things for capital return and lower reserves, things like that, or even just rationalization of the regulators, as we've heard some talk about. But what about the idea of banks being permitted to do more M&A and consolidate again? First of all, do you expect that to start to occur more, quickly in 2025? And also, is that a desirable thing?
It's an interesting point, Mike, because when you take a look at the banking industry and you look at the consolidation we've seen over the last 30 to 40 years, back in the 1980s, we had 18,000 banks and thrifts. Today, we're down to about 4,400. And that consolidation comes in waves, and we have peaks and troughs. We've recently been in a trough under the Biden administration. And we anticipate, based upon the regulatory environment under the first Trump administration, that there will be a lighter hand when it comes to regulation, in particular when it comes to mergers and acquisitions. And so we do see and expect a surge of M&A activity in 2025 and 2026. The other thing I think investors have to remember is that obviously we have midterms in 2026. And should the Senate change hands and moves back to the Democrats, Senator Warren from Massachusetts would be the lead senator on the Senate Banking Committee. Now, granted, the Banking Committee doesn't set regulation for banks, but she could be an obstacle to get deals done. So really, the amount of time you have to get a deal done is, we think, 2 years. So we do expect to see a lot of activity in 25 and 26.